Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists, Stuart and Oriane Parmentier. We're recording this, as usual, on Thursday after a week of, I would say, continued back and forth in the headlines when it comes to the potential for a deal between the US and Iran. There was plenty of market optimism at the beginning of the week, and this has slowly faded, but we're still sort of playing headline tennis, and markets continue to respond in both directions. Away from that kind of day-to-day and the back and forth in the headlines, though, all of us last week were at our NatWest Official Institutions Conference at our headquarters in Edinburgh. So I thought it'd be useful if we use the podcast this week to kind of touch on some of the themes that we were discussing and how that fitted to obviously a somewhat specific, but how that fitted against client views that were there. Oriane and Stuart were both over in Edinburgh from Europe and from the US, so they also did a bunch of kind of one-to-one client meetings around the conference. So I thought it would be useful to get the takeaways from them on how their views fitted versus the clients that they saw. Stuart, since you're not often on the pod, I think it makes sense probably to start with you. So first of all, maybe it would make sense to just kind of set the scene and run through the key themes that you were discussing last week with clients and what your thoughts around them were.
Yeah, absolutely. I think that, first, as you already have, would acknowledge that the elephant in the room is the conflict in the Middle East and the day-to-day vicissitudes of that. That is sufficiently opaque, however, that our conversations focused more on the outlook for Fed policy and therefore market variables. The angle that we've been taking in terms of themes is the affordability theme, which is figuring heavily in the political dialogue in the run-up to the midterm elections. And I think there's a lot to unpack in the affordability theme because it boils down to the choice made by the Fed with respect to the simultaneous shocks of the energy shock. Is it growth or is it inflation? And how will policy be oriented? And we have what I think is a reasonably out of consensus view in that in spite of the price impact, we think that the affordability issue augurs for a more powerful bias towards the growth outlook in terms of Fed policy formation. And the reason for this is ultimately political, but we think that there is a plausible argument that is probably attractive to the administration and their nominees that Fed policy itself is in some way to blame for the affordability crisis. And the issue centers around the policy's necessity of restraining growth in order to hit the inflation target at 2%. And the way we think about affordability is essentially in terms of real income or real wage growth. And we can demonstrate historically that real income growth is positively related to the output gap. So essentially the economy's performance versus potential. And the hypothesis is that the Fed had to constrain growth in the output gap sufficiently in order to hit 2%, that it prevented consistent, robust growth in real income. So that would be the first basis for assigning some blame of the affordability crisis to the Fed. The second is perhaps more readily apparent, and that is the impact of balance sheet growth in QE, whereby the Fed depressed the level of real yields and the real term premium in an effort to herd investors, if you will, into riskier assets. And it turns out that housing has a lot of characteristics of a risk asset. So on the one hand, the need to constrain growth prevented income growth. And then on the other hand, Fed policy also pushed up housing prices. So as a result, you had this malign change in relative prices. You can think of housing in terms of labor. And so to the extent that the political imperative is dictated by issues about affordability, we would expect the Fed to try to run the economy hot. That is, to look through the price impact of the energy shock and focus on growth with the idea that a modestly higher output gap could strengthen real income growth, and then in such a way that housing becomes more affordable. Essentially, that consumers have more money to spend on key items in their budgets or on their balance sheet. So that was the sort of backdrop, and what we took to the market was that the implication is of the affordability issue is not that the Fed will tighten because of inflation, but rather the Fed will look through the price impact and ease in order to focus on growth and employment. And that's obviously not what the market has been pricing. The typical client response in this dialogue was, well, what about inflation? We're above target. And here I go back to my mantra that at this point, my opinion is that above 2% inflation is not policy error, but rather is policy. And one way to think of all of this is that it's not the practice of inflation targeting that is the problem. It's that the numerical target, the calibration was too low. So essentially, the argument could be made that 2% is artificially low, and hence the impact of restraining growth was a decade on the zero bound, and now this emergent affordability crisis. And so the task of the Fed, from that perspective, or given that narrative, would be to, in some way, either de facto or de jure, to re-anchor inflation expectations modestly or moderately higher. So not 5% or not 10%, but something like 3% or a range from 2 to 4%. The implication is that a higher tolerance for inflation could also yield higher real income growth, because history before the central bank practice coalesced around a 2% inflation target, the history does exist of periods in which real income growth would run much faster, say 4%. But at that time, inflation was also running 3 or 4%. So the political imperative, I think, comes from the sort of rhetorical question as follows, which is, would you rather be able to afford a house or have 2% inflation? Would you rather have a job and wage growth or 2% inflation? And so from a political perspective, I think the answer is fairly clear. And the underlying argument here is that we're at a point in which the politics are sufficiently powerful that the public and voters would tolerate institutional change to achieve better outcomes for the average voter or consumer. And clients were, of course, challenged by this because this was a change in paradigm. One of the more interesting tidbits of feedback or opinion from the client base was that, in a way, everyone wins under the scenario that we're drawing. And this is with respect to this metaphor of a K-shaped economy. So the idea is that moderately higher inflation would protect asset values, and that benefits the investing class, and that's the upper arm of the K. Whereas the stronger real income growth would benefit the wage earning class, or the bottom arm of the K. So I think that was the feedback most consistent with the narrative and the view. There were some clients that were saying, well, wait, growth is good enough. There's no need for a shift in paradigm, but rather their expectation was that, as they would have over the last 20 or 25 years, the Fed would set policy to tamp down inflation and reapproach that 2% target. So the only reaction to that, I would say, is that is simply more of the same, and so we should not be surprised if that resulted in more of the same outcome, meaning an affordability challenge. And then the last point that I made in the narrative is that income is actually slowing. Real income is slowing demonstratively and has been since the transfer payments around the pandemic. And there's not a lot of history to reference in the last 20 years, but looking further back into the very late 70s and the 80s, tightening policy in the face of weakening income growth seems to have greatly increased the probability of recession. And so, for that perspective, I think that my opinion is that the likely trajectory of Fed policy is bracketed by unchanged, or a reaction function more centered around the growth outcome rather than inflation, which would be consistent with cutting rates at a deferred time. So, our colleagues in economics at NatWest have at the moment 25 basis point cuts in Fed funds in October, December, and January, taking us modestly below that 3% estimate of neutral. And I think that is consistent with the longer run narrative centered around affordability. So that was the basis of the conversation. I think those were the two sides of the discussion.
So you talked about there being some kind of pushback against the view, and certainly at the beginning when you started talking, you mentioned that this Fed base case was kind of off consensus. Do you think that it's off consensus from the perspective or the basis of your arguments, i.e. what's driving you this kind of affordability rationale that's driving the sort of end viewpoint that either unchanged rates or rate cuts are likely? Or is it because most people actually hadn't even thought about it from that perspective and were thinking more just about the near-term inflationary shock and therefore had hikes as their base case? Do you think consensus was still for cuts, but just the rationale was different and nobody was thinking about it through the same lens as you? Or actually the broad consensus was still for hikes, and nobody had even thought about the kind of longer-term impacts through this affordability lens?
I think that it was more of the latter, and the feedback specifically questioned the ability or the probability of success in re-anchoring expectations moderately higher. And it's perhaps a cynical view, but understandable. And the worry is that a change in the inflation target higher would simply suggest that whenever the inflation target becomes inconvenient, it would be changed again. So a slippery slope that could lead to unanchored expectations. And then, well, no, I think that's probably the crux of it. And then I think there was also simply some institutional inertia, because again, this is sort of off the map. We're at the edge of the map here with respect to what we can learn from history, and the concept of that institutional change was somewhat challenging. I think another point worth making is that there is a strain of thought that all of these challenges and the challenges to institutional structure are unique to the Trump administration. And I would argue very strongly that that's not the case. Just given the political realities, we would expect the opposition party, so here the Democratic Party, to oppose most Trump policy, and that would suggest in the near term that they would tend towards the inflation hawkish side, depress growth while their political opponent is in office. But my argument is that if you were to then take a Democrat and put them in the Oval Office, that they would face the same incentive structure and the same challenges, essentially that fiscal policy is bumping up against the intertemporal budget constraint, if you will. And the only way to reliably provide stimulus to the economy is through the monetary channel. And I would argue very strongly that this is not unique to the Trump administration. The Trump administration might be the wrecking ball for the old paradigm, but I think that this change is necessary and inevitable. And that is because the demographics are compelling enough to suggest that we are simply in a more inflationary environment, that we have a constrained supply of labor, into the medium-term future, the next decade or more. Demand we would expect to recover somewhat. There is implicitly here the judgment that the impact of labor supply constraints are are more determinative than any potential reduction in labor demand due to AI advances, et cetera. That is our argument. And so I think to the specifics of your question, I think that current market consensus is certainly rooted within the current paradigm, and the client base seems to still be thinking in terms of nearer term inflation dynamics, vis-a-vis a structural change due to a demographic wave that might, provide the conditions under which the institutional infrastructure could be changed.
Thank you, Stuart. That is super interesting. Okay, Oriane, let's switch over to Europe then. And like Stuart, you were traveling last week. You came to the Official Institutions Conference and spoke to many clients as well. So I guess similar question to you to start out. What kind of themes were you talking about most prominently when it came to Euro area markets?
Yeah, so I would say that there were really three main themes in the conversations that we had last week. The first one was obviously around the ECB with the June meeting approaching. And I think here there was a broad alignment around a June hike being almost inevitable. But I think largely for credibility reasons rather than, as a macro necessity. It's really path of least resistance for the ECB at this stage. And it's also very much consistent with our own view. Beyond that, I would say the tone was perhaps more cautious. Investors we spoke with were quite sympathetic with our views that central banks shouldn't react mechanically to an oil-driven shock in theory, especially with inflation expectations still well anchored, and since we haven't seen meaningful second round effects for now. So this has been quite clear in our framework, but I think the fact that the path forward becomes more conditional with a meeting by meeting approach was also an approach that was shared by the investors with whom we spoke. Even the possibility of just one hike, I think, is very much on the table, depending obviously on how the Middle East situation evolves. And it was interesting to see last week, notably with the weakening European PMIs and general growth indicators in Europe, I think, reinforcing this idea of a weaker growth backdrop. And I think that brings the inflation versus growth trade back into focus. And in our view, suggests perhaps that markets may be overestimating how much tightening is still to come. From a market perspective, we continue to think that it argues for curve re-steepening, particularly via two stands if hikes get priced out. But even if the hikes currently priced do get delivered, our view is that the next step is markets pulling forward cuts into 2027 as you'd expect demand to weaken. The second theme was more structural and is also a key part of our house view. So we've discussed how defense-related issuance is going to be sustained in the coming years, and this comes on top of already heavy funding needs. We have also major investment requirements in AI, as well as the energy transition. So this is all happening in a world of already higher rates. And I think, the fact that Europe is facing a kind of financing wall at this particular time advocates for higher term premia and structurally steeper curves. We continue to favor steepening position in two stands as well as 1030s, and we are sticking with our 3.20% year-end 10-year bond target, even if we acknowledge near-term geopolitical risk to this target. The third theme was around inflation expectation and oil dynamics and how they all fit together. What we've been highlighting and discussed with clients is that the macro backdrop today is very different from 2022. We have fewer supply bottlenecks, less fiscal stimulus, and different demand dynamics. So the starting point is obviously quite different. And I think that explains why inflation expectations have remained quite resilient, really, in Europe. And I would say even if we were seeing hikes being priced out, I don't think we would necessarily see a de-anchoring in inflation expectation, especially if growth concerns become more prominent, I would say. On oil specifically, we discussed notably the fact that Russian crude may still be reaching global markets via indirect channels. And that combined with large stockpiles, so especially in China, could be also an important factor limiting the scale of price spikes. And I thought that was an interesting discussion. So stepping back, I would say these are really the three themes that we've been discussing with clients. We had some early questions starting to come through as well on political risk in 2027, but I think that's less of a near-term focus and probably one for another podcast.
Across those themes, how would you say they kind of fitted with consensus views? Was there anything that you felt like, you were off consensus compared to client opinion, or anything that had a lot of pushback? What stood out to you when we kind of compared those key themes relative to what clients were thinking?
To be fair, I would say overall there was actually quite a lot of alignment with our views across the themes. On the ECB, we didn't get that much pushback on the idea of this meeting by meeting approach and the fact that, perhaps to market had been a bit quick to price so many hikes. And it seemed, this idea of a gradual meeting by meeting approach, data dependent path for the ECB seemed like a rather natural base case for most of the investors we spoke to. On the curves view, I would say investors did agree with the steepening story conceptually, but the hesitation, I think, there was quite naturally about the timing rather than the direction. And I think given the current geopolitical uncertainty, clients are obviously more cautious about when, especially to express this position, even if they agree with the medium-term outlook, I would say. But maybe turning to the UK, Imogen, would be great to hear your take and the theme that you've been discussing with clients, particularly around gilts.
Yeah, so my week was a little bit less exciting, I think, than either yours or Stuart's. I was just at the conference and not doing much around that, and it was a very short trip at that. So our discussions were from a lens of perhaps not investors that were always so focused on the UK. So we spent a lot of time talking about how this energy shock is, a global one in nature. It's kind of the same across the board, but it's going to play out very differently in different economies. And we were talking about the reasons for those differences and why the UK is different to its peers. And for me, that really boils down to two key things. And the first is the inflation backdrop. And we've talked about it a lot on this podcast before, but, the fact that the Bank of England is really approaching this new crisis, this energy cost shock, with excess baggage. It's made less progress against meeting its inflation target than the ECB and the Fed has. It perhaps has a bit less credibility around potentially reaching that target in the future. And that, we think, will generate a slightly different reaction function and perhaps change the way that the market thinks about that reaction function as well. It's the Bank of England is not the Fed with a dual mandate that can kind of look through price increases with a view to achieving its growth mandate, as Stuart has just kind of run through in lots of detail. And it's not the ECB, where inflation was, trending at target essentially, and rates had got back to neutral. We're an economy that still has service price inflation, a kind of proxy for domestically generated inflation pressures above 4%. We're still dealing essentially with the effects of the past energy cost shock of 2022. We haven't had headline inflation close or below 2% for any length of time since then. We sort of fleetingly got below it on a very temporary basis, basically on the back of favourable base effects. But otherwise, we have had inflation for a sustained period of time. above target, and that has implications for price and wage setting behaviors in the economy, and therefore, that has implications for the way that the economy responds to a second or a subsequent energy cost shock, and what the central bank might need to do about that. Listeners of the pod will know that we've taken that to interpret a slightly more hawkish reaction function from the Bank of England. We still have 2 rate hikes in our projections. We have those penciled in, 2 quarter-point rate hikes penciled in Q4 and Q4 of this year, Q1 of next year, which is in totality not that different to kind of market pricing for the cumulative amount of tightening that might be delivered over the next 12 months. But the difference really comes in the timing of those hikes. I mean, at times over the last couple of weeks, we've been very different to market pricing, and we're now much more closely aligned. But we've always been a little bit skeptical that those hikes could be delivered early, not because the BOE is facing a smaller inflation shock than anybody else. And in fact, quite the opposite. If you're worried about an inflation shock in the euro area, I think you'd be equally, if not more, worried about one in the UK for the reasons I've just laid out. But really because we think that this central bank is one that's more reactive than proactive. And I guess that's a big difference when we think about, the way that our house view has evolved for the BOE versus the ECB, for example. They've signalled, quite a want to be a bit more proactive to kind of ensure that inflation expectations are anchored and get ahead of the curve, despite the macroeconomic case for rate rises being relatively weak. And yet we think actually the macroeconomic case in the UK is much stronger for rate rises. But we think that this is a central bank that will want to kind of wait and see, and will want to see more evidence of at least a potential for those second round effects. And, it's important, I guess another point to remember that's slightly different in the UK is that we're not yet seeing the evidence of those first round effects, in part because of the dynamics in the energy market and the energy price cap. So, consumer energy prices have been artificially or held artificially low because this price cap moves only on a quarterly basis. And so we haven't had an Ofgem energy price cap update since the beginning of the war. So, so far, even headline inflation has remained relatively well behaved in the UK. In fact, we had downside surprises across the board on the inflation data last week. But that is set to change. In the coming months, we will see. We've just had the news that the energy price cap has been revised up quite significantly in line with expectations. But we will start to see, clearer evidence then of the inflation shock on, having first round effects. And then we can start to think more clearly about those second round effects, which might necessitate a bit more of a central bank reaction function. The second difference, or where the UK sets itself apart, I think, are the implications from a fiscal perspective. Of course, war is sort of costly everywhere. There are pressures on increased and accelerated defence spending everywhere. The war is arguably far more costly for the US than it is for the UK on a day-to-day basis. But, there was lots of focus on what's the difference between the UK's kind of political fiscal situation and others. And I guess more specifically, the question that we get asked a lot, I think specifically from overseas investors, is why are gilts punished so much as soon as kind of political or fiscal risks start to enter the narrative? And so we spent a bit of time at the conference last week kind of breaking down the drivers of our bearish view in the UK, but why these kind of fiscal risks weigh more heavily, or they're more worrying in the UK than elsewhere. So why is it that the market kind of punishes the UK so much when we start to get worried about fiscal risks anywhere? This has been a long-held view of ours for, well, I think years, I would say. So I think all of these drivers we've probably gone through at some point on this podcast in recent weeks or months or even years. But I think it's worth recapping, as it's something that's been coming up a lot recently, not just at the conference last week, but in a lot of our client conversations, that this idea that the UK's fiscal backdrop isn't any more worrying than the US. How is it different to France, where it's difficult to pass a budget, etc., etc. So a couple of points that I think are worth highlighting. Again, not many of them are particularly recent, but I think they're easily forgotten when we get tied up in the kind of day-to-day of everything. Firstly, borrowing is high everywhere. We're clearly in a very elevated borrowing environment compared to pre-COVID. And the numbers in absolute terms, when we talk about issuance in the UK versus other countries, or debt levels in the UK versus other countries, are particularly worrying. But when we think about that increase in net supply in the UK relative to pre-COVID, versus the US or versus the euro area, it has been much higher. So relative to the size of the market, that increase in borrowing has been much more concerning. Part of that is because the BOE has been doing QT at a much faster pace than the Fed or the ECB. The Bank of England has shrunk its gilt holdings by about 40% since it began QT. The ECB's balance sheet is only about 30% down, and I think the Fed's is about 15% down. So QT has been faster, and the way that the Bank of England does QT is obviously different to how it occurs in other countries. The Bank of England actively sells bonds back to the market. That's partly a function of the weighted average maturity of gilts, and the Bank of England bought kind of market neutral way. So their stock of holdings has a longer weighted average maturity. So if they were just to let it roll off naturally, it would, obviously take much longer. But the bigger problem, in my view, is not that they're actively selling bonds back to the market, but of course they are actively selling back those bonds to loss. And the Treasury, the way that the QT or the asset purchase facility in the UK was designed initially, was that the Treasury would be on the hook for those losses, in the same way that the Treasury benefited from any kind of profit that QE made when it came to, the interest earned, the coupon that the Bank of England earned on the bonds, or if it were to sell bonds back for a profit. It's a bit extreme to suggest we're in this kind of QT doom loop where you have the Bank of England selling bonds back at a loss, which means that the Treasury has to borrow more on the market to pay the Bank of England back for those losses, which pushes yields up even further, which means that the Bank of England then sells the bonds back at an even bigger loss. But that's the sort of dynamic that we're risking in the UK when it comes to quantitative tightening. Debt servicing costs are high. They're higher in the UK as a proportion of GDP than they are in the US, which, when you think about the relative size of the debt stock, is quite a concerning statistic. And, in an environment where we're talking about potentially bigger rate rises in the UK, but also, potentially a bigger structural inflation problem. It's worrying more for the UK than elsewhere, given how much of its debt stock is still inflation linked compared to its peers. And, that was one of the problems post 2022 was just how quickly our net interest costs rose because of that inflation linked debt stock. So from a fiscal sustainability lens and a rising inflation environment, I think it's right to be more concerned about the UK than elsewhere. The UK has also been subject to bigger demand side changes. I mean, that's something we've been through at length on this podcast over the last couple of years, but just this shift from generally kind of longer dated, more price insensitive investors to shorter dated, more price sensitive investors. That's a dynamic that has been quite unique to the UK. So it's kind of a unique supply demand imbalance. And then finally, it's the political instability, which again has been quite unique to the UK. We've had, I think I gave my fun fact on this podcast a couple of weeks ago around the number of that no Prime Minister has served their full term since 2015. So, we're potentially going to have a sixth Prime Minister in 7 years. And we've had even more chancellors associated with that number of Prime Ministers. So, there's a real element of political instability, policy uncertainty, which has knock-on effects from a growth perspective. And that, again, creates a sort of self-fulfilling cycle. Because of that demand shift away from those kind of domestic institutional investors in the form of pension funds, we rely now much more heavily on overseas investors than we have in the past. The share of overseas investment has gone from about 25% in terms of the total gilt market holdings to about 35% now over the last 6 or so years. And naturally, those investors are more sensitive to kind of those political fiscal risks. And so, every time there's a kind of spike in volatility around these political events, you get those investors remaining on the sidelines. We see that very clearly in the run up to things like the budget, the local elections, etc. But of course, the more that your marginal buyers remain on the sidelines, the more volatile the market moves become, and so on and so on. So I guess with all of that in mind, and particularly against the backdrop with which the conference took place, things have moved on, I guess, a bit over the last week, but the kind of domestic politics was still quite high up on, in terms of headlines last week. There was lots of talk around the potential leadership challenge, Andy Burnham's by-election in a couple of weeks. So I think that, with all of those factors in mind, the key question, I guess, was, are these fiscal political risks fully priced now? To which it won't surprise anyone to know that I said I don't think they are. We're obviously a long way off the highs now in yields, where some kind of 15, 20 basis points higher even than, lower than last week. It's difficult to necessarily measure all the time how much political risk is being priced in, particularly because it influences lots of factors. It's not just about looking at the underperformance of the long end of the curve, for example. We've got to consider the fact that fiscal expansion has inflationary impacts, that has knock-on effects for the way that the market might price the Bank of England's reaction function, etc. But an imperfect way of looking at it is to regress gilt yields on a number of kind of UK specific and global macro and market factors, and assume that residual is a decent proxy for political risk. I say imperfect because there's the obvious limitations to that, but it gives you a framework, I think, for thinking about that political risk. And we can see that, obviously it rose quite clearly in recent weeks in the run-up and weeks after the local election. But it's fallen away very quickly after we had Andy Burnham's comments 10 days or so ago around him having no plans to change the fiscal rules. And that's where I think maybe my view versus the market view differs a little bit. I'm a bit less convinced that a politician saying he has no plans to change the fiscal rules doesn't mean that he won't change them if he comes under pressure. And that pressure could easily materialise as the election nears, and there's a need to kind of spend more to shore up support from his base. If you'll recall 2024, Rachel Reeves had a similar rhetoric around the fiscal rules being ironclad, only for her to change them after the first couple of months in office. So having no plans is not the same as having it in your manifesto that you won't tinker with the fiscal rules. And of course, there's other ways as well to allow for more borrowing. You can change you can change the way that the OBR assesses the economic impact of your policies. You can change the makeup of the OBR, etc., etc. I guess my point being that I just think that there's a higher chance of kind of fiscal mission creep over the next couple of years than perhaps the market is pricing in. And to put that into context with our 5.25% yield target, given what we think about rise in global term premia, bank rate view, the kind of inflation expectations, etc. in the UK, it's not like we think political risk needs to rise back to 2022 levels, or that we're talking about a Trust 2.0 event that would take yields back to 5.25. It's just, I think that probably they are more elevated than the market is currently pricing.
Right, and could you tell us perhaps how clients have been responding in general to those themes, and if there was any pushback?
Yeah, I mean, like I say, last week I was only at the conference for a short time, and I did no one-to-one meetings around that, which makes me sound quite lazy because I know you two were very busy. So I have less of I think I have less of a sense of how that fits versus client views from last week specifically, although we did have the advantage that in the UK strategy session, we did a couple of Slido questions to begin with, so we could kind of get the sense of the tone in the room. And I should perhaps caveat that we did ask these questions before we started talking, so we didn't influence those in the room in terms of their responses. But I guess two things that stood out to me. The first was that more than I thought, a slim majority, but a majority nonetheless, thought that gilts were fair value. And I guess, again, it's important to note that that was kind of 20 basis points ago higher in yield. And so if your sort of assessment of the underlying macro, global risks, political risks, etc., haven't changed all that much in a week, then at these levels, perhaps it's fair to say that most of those investors in the room would actually think that gilts were looking a little bit rich. For completeness, only around 15% at the time in the room thought that gilts were rich. And the second point was just around the Bank of England view. The interesting thing for me here is that a couple of weeks ago, we were on the road doing a lot of real money, fast money, London-based accounts meetings. We spoke about it on the podcast at the time, but the key takeaway from those meetings was that we were far more hawkish, even though we weren't that much more hawkish than market pricing, or we weren't more hawkish at all than market pricing, but we were much more hawkish than the vast majority of those accounts that we spoke to. But actually, there appeared to be a little bit more of a hawkish, not versus the market, but versus those meetings a couple of weeks ago. A bit more of a hawkish viewpoint in the room in Edinburgh. Again, the sort of majority, not an overwhelming majority, but around 50% of respondents thought that the Bank of England would hike at least once, and 33% thought that there would be 2 hikes. So there was a kind of hawkish tail to the responses compared to only 10% in the room that thought there would be unchanged rates, which is quite different, I think, to the responses. If we'd have run the same survey on a different set of clients just a couple of weeks ago, we would have had a much more dovish outcome. And then the final pushback maybe around our sort of fiscal risk viewpoint was just around this idea that those fiscal risks actually exist under a new prime minister, and our sort of assumption that there's more borrowing to spend more and that there's a dilution of the fiscal rules to allow that. Actually, could that higher spending be funded by more taxes instead? And so why does it necessarily mean more fiscal risk? Does it just mean, weaker growth outcomes, continued slowdown in investment from the corporate sector, but actually from a market's perspective, no more borrowing, and therefore that risk is sort of mitigated when we think about gilt yields. Of course, that's an option, and I don't think that higher spending will be funded totally by more borrowing. But and it's not an easy choice whether to sort of at the extreme break your manifesto pledges or change the fiscal rules. But I think as we head into that next election with Labour polling the way that they are, the impetus will be on the politics rather than on the economics. And so I think raising borrowing would still be preferred to breaking manifesto promises. And that's why we kind of see those fiscal risks developing. That's probably enough from all of us. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to tune into our other NatWest podcasts, Currency Exchange and Trade Links. Thanks. See you next week.